Hello everyone, I'm Julia Charlton, the Managing Partner of Charlton's, and I'm delighted to be with you today to talk about the Hong Kong Stock Exchange's latest consultation on its proposed amendments to the Corporate Governance Code and the related listing rules. In this webinar, I'm going to go through the Exchange's proposals as set out in the consultation paper, the Exchange's stated rationale for the proposed changes, and the comparable requirements for companies listed on other major stock exchanges. I hope that this will give you a fairly comprehensive understanding of the corporate governance standards being proposed and an insight into how they compare with the requirements on other international markets. So moving on to the consultation proposals. As you probably know, the corporate governance obligations and disclosure requirements for Hong Kong listed companies are set out in the main board and GEM listing rules and in the Corporate Governance Code, which is Appendix C1 to both sets of rules. The Corporate Governance Code's provisions consist of principles, mandatory disclosure requirements, code provisions, and recommended best practices. Mandatory disclosure requirements are compulsory provisions that all listed companies must adhere to. Non-compliance with these requirements constitutes a breach of the listing rules. The code provisions, on the other hand, apply on a comply or explain basis. This means that listed companies can deviate from the code provisions depending on their circumstances, but must give a reasoned explanation for any deviation in their corporate governance reports included in their annual reports. Recommended best practices are voluntary guidelines. Listed companies are encouraged but not obliged to disclose whether they have complied with these practices. The Exchange's proposed changes to its Corporate Governance Code and related listing rules were set out in a consultation paper published in June 2024, for which the consultation period ended on the 16th of August 2024. The Exchange plans to implement the changes from the 1st of January 2025, but will allow a 3-year transition period for certain amendments relating to independent non-executive directors, often referred to as INEDs, which I'll explain later. According to the consultation paper, the proposed changes are the result of the Exchange's analysis of a sample of listed companies' compliance with the corporate governance requirements in 2022, its review of the corporate governance requirements of stock exchanges in the UK, Singapore, Australia, Malaysia, and mainland China, and stakeholder feedback. In the consultation paper, the Exchange states the overall aim of the proposed changes as being to strengthen the corporate governance practices of Hong Kong listed companies. It lists its specific aims as improving board effectiveness and independence, increasing board and workplace diversity, enhancing the Corporate Governance Code's risk management and internal control provisions, and encouraging listed companies to improve their capital management by introducing increased disclosure requirements regarding listed companies' dividend policies and their board's dividend decisions. The Exchange has proposed a number of changes which it claims are aimed at enhancing the effectiveness of listed company boards. One of its key proposals is the introduction of a new code provision C17 that would require listed companies to appoint one INED as a lead INED, where the board chairman is not an INED, and or the roles of the chairman and CEO are performed by the same individual. The note to that code provision would add that where a listed company has a chairman who is an INED, that person must fulfill the role of lead INED unless another INED has been appointed to that position. According to the draft code provision, the lead INED's role would be to facilitate communication between a listed company's shareholders and its board, and to provide an alternative channel of communication for shareholders and directors where the communications channels with the company's chairman or management prove to be inadequate. The Exchange's rationale for this proposal is that investors have apparently voiced concerns about their access to INEDs and have said that a lead INED may improve communication between shareholders and INEDs and the wider board, particularly where the listed company has the same individual performing the role of both CEO and board chairman and/or is family controlled. However, beyond what is stated in draft code provision C17, there is no clear guidance in the proposed code amendments on what the lead INED's role would entail. The consultation paper states that lead INED's principal responsibility would be to facilitate and strengthen communication among INEDs, between INEDs and the rest of the board, and with shareholders. and that they should act as a channel of communication to enable shareholders, in particular minority shareholders, to understand the actions taken by INEDs in the performance of their responsibilities, and as an intermediary between directors and shareholders where contact through normal communication channels is inadequate. According to the consultation paper, the stock exchange is planning to provide guidance on the role and functions of the lead INED in future. The lead INED provision would be a comply or explain provision under the code, not a mandatory requirement. The consultation paper gives as an example of a reason that a listed company could give for not appointing a lead INED that the listed company has alternative effective shareholder communication mechanisms in place. Although lead INEDs would have additional responsibilities as compared to the other INEDs in acting as a communications channel between investors and the board, the exchange says in the consultation paper that the lead INED designation is not intended to create a separate or higher level of responsibility or liability relative to other INEDs on the board. It goes on to say that all directors would still be subject to the same fiduciary duties and bear the same responsibilities in respect of the issuer on whose board they serve. The consultation paper also says that since INEDs are generally not involved in the daily management of listed companies, lead INEDs would not be expected to respond to shareholders' questions about the listed company's operations. As to the other requirements for a lead INED on other stock exchanges, the London Stock Exchange's Corporate Governance Code requires a lead INED to be appointed on a comply or explain basis. Its role is to provide a sounding board for the chairman and to act as an intermediary for the other directors and shareholders. However, the shares of UK listed companies, unlike those of Hong Kong listed companies, are typically very widely held, which possibly justifies the role of a lead INED as an additional communication channel between shareholders and the board. In contrast, many Hong Kong listed companies have majority shareholders, and their shareholdings are typically more concentrated, which may make a separate communications channel less important. Larger Hong Kong listed companies with large numbers of shareholders often have separate shareholder relations departments, which can ensure effective shareholder communications, which may mean that the need for a lead INED as a shareholder communications channel is less important in Hong Kong. The requirement to appoint a lead INED for companies listed in Singapore applies on a comply or explain basis, where the chairman is conflicted or not independent. Companies listed on NASDAQ and the New York Stock Exchange are not required to appoint a lead INED. That said, a considerable number of US listed companies have voluntarily appointed a lead INED, generally where the CEO is also the board chairman. There is no requirement for US listed companies to have separate individuals performing the roles of CEO and chairman, as there is under the Hong Kong Corporate Governance Code, where it's a code provision. According to the academic literature, the role of a lead INED was developed in the 1990s in the US to provide an alternative for listed companies that were unwilling to separate the role of CEO and board chair. The lead INED role was developed as a way to allow them to enjoy the benefits of having a single person as both CEO and chair, while achieving a more independent board through the appointment of a lead INED. The idea was that a listed company's INEDs would be more effective if they had leadership from the lead INED. The appointment of a lead INED was intended to act as a counterbalance to a single CEO and chair. US listed companies that appoint a lead INED typically define the scope of their duties in a lead independent director charter. The exchange is also proposing to introduce new listing rule requirements on directors' training. First of all, listed company directors would be required to participate in continuous professional development training on specified topics, although there'll be no set minimum number of training hours. Secondly, the exchange is proposing a new listing rule that would require all first-time directors to complete 24 hours of compulsory induction training on the specified topics within 18 months of their appointment. Currently, the provisions on directors' training are code provisions under the Corporate Governance Code. These code provisions are far less prescriptive than the proposed new listing rule requirements. Code provision C11 currently requires newly appointed directors to receive comprehensive, formal and tailored induction, but does not specify what it should cover or how long it should last. Directors' continuous professional training is currently covered by Code Provision C14, which requires directors to participate in continuous professional training that gives appropriate emphasis to the roles, functions, and duties of listed company directors, but does not specify a fixed number of hours. According to the consultation paper, the proposed 24 hours of induction training for first-time directors under the new listing rules would be required in addition to the general induction training that listed companies are already required to provide to new directors under Code Provision C11. The exchange is proposing to define first-time directors as new directors who have no previous experience of being a director of a Hong Kong listed company and directors who have not been a director of a Hong Kong listed company for 3 years or more. If a first-time director ceases to be appointed as a director before completing the required 24 training hours, the training requirement will be reset and the director will have to restart their 24 training hours the next time they're appointed as a Hong Kong listed company director. As to the disclosure requirements in relation to directors' training, Mandatory Disclosure Requirement B1 currently requires listed companies to disclose in their corporate governance reports how each of their directors has complied with the continuous professional development requirement. The exchange is proposing to revise that mandatory disclosure requirement to require listed companies to confirm that each of their directors has complied with the listing rules training requirements. For first-time directors, companies would have to confirm that they have completed the mandatory 24 hours of induction training. Listed companies would also have to set out specified details of the training completed by each director, including the name of any external training provider and the number of hours of continuous professional development training completed by each director, the topics covered by the continuous professional development training and its format, for example, whether it was provided online or by physical attendance. Listed companies will be free to designate the format in which the training will be given. In the consultation paper, the exchange commented that one of the main reasons listed companies breach the listing rules is that their directors do not fully understand their responsibilities and the requirements of the listing rules. The exchange also emphasised in the consultation paper the importance of informing directors of changes to the regulatory requirements. The exchange is therefore proposing to require that both first-time directors' induction training and directors' CPD training should cover what it sees as the key areas of responsibility of listed company directors, which will be set out in the listing rules. The proposed mandatory topics cover the roles, functions and responsibilities of a listed company's board, its committees and directors and board effectiveness, and the obligations of listed companies and their directors under Hong Kong law and the listing rules. Training would also have to cover the key legal and regulatory developments relevant to the obligations of listed companies and their directors. Other mandatory training topics are risk management and internal controls and corporate governance and ESG matters, including developments on sustainability or climate-related risks and the opportunities relevant to the listed company and its business. Finally, directors' training would need to cover updates on industry-specific developments, business trends and strategies that are relevant to the listed company. As to the requirements for new directors to receive induction training on appointment on other stock exchanges, Singapore, for example, requires external course providers to provide induction training, but only to first-time directors who are defined as directors who have never served on the board of a Singapore-listed company. The Singapore Stock Exchange has no requirement comparable to the Hong Kong Stock Exchange's proposal to require directors to complete 24 hours of mandatory induction training if they have had a 3 or more year break from being a listed company director. Companies listed on the Australian Stock Exchange are subject to a comply or explain provision that requires an induction program for new directors and regular reviews of whether training for existing directors is required. In the US, although the New York Stock Exchange's rules do not mandate director training, the New York Stock Exchange Listed Company Manual requires listed companies to address director orientation and continuing education in their corporate governance guidelines. The provisions for companies listed on the Australian Stock Exchange and the New York Stock Exchange, however, do not specify the areas that directors' training must cover. The Exchange's next proposal is to upgrade the current recommended best practice regarding board performance reviews to a code provision. Recommended best practice B15 currently recommends that a listed company board should conduct regular evaluations of its performance, but does not provide guidance on what is meant by regular. Under the proposal, listed companies would have to conduct board performance reviews at least every 2 years, or disclose reasons for not doing so, but would be free to choose the format of the review and whether to conduct it internally or appoint external providers. The new code provision would also require listed companies to disclose specific details of the board performance review in their corporate governance reports. These include the scope of the review and details of the findings, including any significant areas for improvement identified by the review, and the measures taken or planned as a result. Listed companies would also need to disclose whether the review was conducted internally or externally, and any connection between the company or its directors and an external review provider. The Exchange's rationale for upgrading the board performance review recommendation to a code provision is that it considers that these reviews help the board to identify areas for improvement. According to the consultation paper, the Exchange expects the review to be of the board's performance as a whole rather than of the performance of individual directors. The consultation paper also notes that the board performance review may consider matters such as the board's composition and diversity, directors' skills and qualifications, how the board works together to achieve the listed company's objectives, and whether the board is equipped to deal with any future risks that may affect its business. Looking at the requirements for board performance reviews on other stock exchanges, the London, Australian, and Singapore stock exchanges all require the conduct of a board performance review and disclosure of its conduct in listed companies' annual reports on a comply or explain basis. In the UK, that review is required annually. The board chair should also commission a regular external board performance review, and for FTSE 350 companies, that is larger issuers, that external board performance review should be conducted at least every 3 years. In the US, the corporate governance guidelines of companies listed on the New York Stock Exchange are required to provide for the board's annual self-evaluation of its performance. The Exchange is also proposing to introduce a new code provision requiring listed companies to maintain a board skills matrix, which they would need to disclose in their corporate governance reports. The board skills matrix would need to include details of the board's current mix of skills and explain how the combined skills, experience, and diversity of its directors serve the listed company's purposes, values, strategy, and desired culture. The matrix would also need to set out any additional skills the board is looking to acquire, its plans to acquire those skills, and how the company achieved or progressed its plans to obtain additional skills in previous years. This would apply in addition to existing code provision B31A, which requires the nomination committee to review, at least annually, the board's structure, size, and composition, including its skills, knowledge, and experience, and make recommendations on proposed changes to the board to complement the listed company's strategy. The Exchange says in the consultation paper that the aim of this proposal is to assist listed companies in board refreshment and succession planning. Australia requires listed companies to have and disclose a board matrix setting out the skills the board has and those it's looking for. That is a comply or explain provision. The Singapore Stock Exchange, on the other hand, has a listing rule requirement that listed companies must disclose in their annual reports how their directors' skills, talents, experience, and diversity combine to serve the needs and plans of the listed company. In the US, companies listed on NASDAQ and the New York Stock Exchange typically disclose a board matrix in the proxy statement and meeting notice sent to investors before the annual meeting for reappointing the board, rather than in their annual reports. However, this is not a requirement for US listed companies. Two of the most contentious proposals in the consultation paper relate to listed company INEDs. The first of these is a proposed new listing rule that would impose a hard cap of 6 on the number of concurrent Hong Kong listed company directorships an INED can hold. Directorships include executive and non-executive directorships, as well as INED directorships. If implemented, companies filing listing applications on or after the 1st of January 2025 will need to ensure that none of their proposed INEDs have more than 5 other listed company directorships. The exchange will reject listing applicants with INEDs that breach the 6 listed directorship cap, which are referred to as overboarding INEDs. As regards existing listed companies, to give companies with overboarding INEDs the time to appoint replacement INEDs, the exchange is proposing a 3-year transition period so that the new listing rule would take effect from the 1st of January 2028. Overboarding INEDs will have to comply with the new listing rule by the end of the first annual general meeting of the companies of which the person is a director, held after the 31st of December 2027. Listed companies with overboarding INEDs will have to remove them from their boards before the conclusion of their 2028 annual general meetings. According to the consultation paper, at 31st December 2023, there were 23 INEDs serving on 7 or more listed company boards, on the boards of 181 listed companies, which is around 7% of all Hong Kong listed companies. 5 of those INEDs held 10 or more listed company directorships. The exchange's rationale for the proposed cap is its concern that directors with a large number of listed company directorships may not have enough time to properly discharge their duties with respect to each of the listed companies whose boards they sit on. In the consultation paper, the exchange emphasises the role INEDs are expected to play in scrutinising listed companies' performance, acting as an independent voice and taking the lead where potential conflicts of interest arise. The exchange previously proposed a cap on the number of listed company directorships INEDs are allowed to hold in 2010, but the proposal was opposed by a significant majority of respondents to the consultation. According to the consultation paper, the exchange considers that the demands on listed company boards have become more complex and time-consuming, and it is therefore proposing a hard cap, again, to prevent INEDs from holding multiple directorships with Hong Kong listed companies. Currently, Code Provision B34B requires that where the board proposes a resolution to elect as an INED an individual who will be holding their 7th or more listed company directorship, the board must set out in the circular to shareholders and/or the explanatory statement accompanying the notice of the relevant general meeting why the board believes that the individual would still be able to devote sufficient time to the board. This code provision will be repealed when the proposed hard cap comes into effect on 1st January 2028, but must be complied with during the transition period. Code Provision B21, which will continue to be included in the Corporate Governance Code, also requires directors to ensure that they can devote sufficient time and attention to the listed company's affairs and to not accept a listed company directorship if they're unable to do so. As stated in the consultation paper, the exchange considered comparable requirements in mainland China, which prevent an individual from holding more than 3 INED directorships concurrently. The exchange also refers in the consultation paper to the Hong Kong government's guideline, which prevents an individual from being appointed as a non-official member of more than 6 advisory and statutory bodies at any one time. However, the Hong Kong proposal for a hard cap on the number of Hong Kong listed company directorships INEDs can hold would make it an outlier among international stock exchanges. None of the exchanges in Australia, Singapore, the UK, Malaysia, or the US impose a hard cap on the number of concurrent directorships and instead require disclosure of directors' other material directorships. Some companies listed on NASDAQ and the New York Stock Exchange have opted to impose a cap, which varies depending on the particular company. For example, Apple has a cap of 5 listed company directorships, while Microsoft has a cap of 4 listed company directorships. The exchange is also proposing a new mandatory disclosure requirement that would require a listed company's nomination committee to annually assess each director's time commitment and contribution to the board and their ability to effectively discharge their responsibilities, taking into account their other listed company directorships and other significant external time commitments. Significant external time commitments would be defined as other significant time commitments, such as directorships of companies listed overseas, full-time occupations, consultancy work, major public service commitments, and directorships of or involvement in statutory bodies or non-profit organisations. The nomination committee's assessment of each director's time commitment and contribution to the board would then need to be disclosed in the listed company's corporate governance report. The Exchange's second major proposal relating to INEDs is to introduce a listing rule imposing a hard cap of 9 years on the tenure of INEDs. Currently, Code Provision B23 requires that the reappointment of an INED who has served for more than 9 years, a so-called long-serving INED, must be approved by a separate shareholders' resolution. The papers accompanying that resolution must state why the board or the nomination committee believes that the director is still independent and should be re-elected. However, there's no limit on how long an INED can serve. Under the proposed new Main Board Rule 313A and Gem Rule 509A, an INED would not be considered independent after serving for 9 years, although under the proposal, the INED could be reappointed after a cooling-off period of 2 years. During the 2-year cooling-off period, directors would not be allowed to take up any directorship in any of the listed company's subsidiaries or holding companies. The 9-year period begins on the date the INED is appointed or the date on which the company listed on the exchange if the INED was appointed before listing. If during the 9 years the INED ceases to be an INED and is later reappointed and the break is less than 2 years, that period when the person was not an INED will still be included under the 9-year tenure. Under the proposed listing rule changes, INEDs serving for more than 9 years would still be eligible to be reappointed, but only as non-executive directors rather than as INEDs. The Exchange is proposing to allow a 3-year transition period for this new listing rule to allow listed companies with long-serving INEDs to make arrangements to replace them. The new listing rule, if implemented, will take effect on the 1st of January 2028. INEDs with 9 or more years tenure at 31st December 2027 will need to be replaced by the conclusion of the company's first annual general meeting, held after that date. A director whose 9-year tenure ends on or after the 1st of January 2028 will need to be replaced by the conclusion of the AGM following the completion of the 9-year tenure. According to the consultation paper, as of 31st December 2023, around 1,500 directorships were held by INEDs who have served more than 9 years. These long-serving INEDs sat on the boards of around 810 listed companies, that's about 31% of all Hong Kong listed companies. In addition, around 30 listed companies had INEDs who were all long-serving INEDs. According to the consultation paper, the Exchange considers that long-serving INEDs' familiarity with the listed company's management is likely to impact their independence and objectivity. It therefore considers that removing long-serving INEDs from boards will increase board independence. As to what is meant by independence, the Exchange said in the consultation paper that listed company boards commonly cite satisfaction of Listing Rule 313 independence criteria to support their belief that a long-serving INED is still independent. The Exchange commented that meeting these criteria alone is not enough to demonstrate that a long-serving INED has independence of mind and can make an independent and objective contribution to the board. In fixing the maximum number of years service, the Exchange points to the Hong Kong Monetary Authority guidelines for INEDs of authorised institutions, which states that more than 9 years service may impact INEDs' independence and recommends boards to record the reasons why it considers that the long-serving INED is still sufficiently independent to serve as an INED. In the consultation paper, the Exchange also cited institutional investors who consider that more than 9 years service impacts INED's independence. As to the requirements of other exchanges, the Singapore Stock Exchange imposes a cap of 9 years on INED's tenure. while the Malaysian exchange imposes a 12-year cap. Mainland China has the strictest requirement prohibiting iNodes from serving more than 6 consecutive years. The commentary in the Australian Stock Exchange's Corporate Governance Code gives more than 10 years tenure as an example of factors that may affect directors' independence, and it recommends boards to regularly assess the independence of any director who's served more than 10 years. However, it also notes that the mere fact that a director has served on a board for a substantial period does not mean that the director has become too close to management or a substantial shareholder to be considered independent. Similarly, the UK warns that more than 9 years tenure may impact independence, but does not prohibit long service. There are no requirements to limit iNode's tenure on the New York Stock Exchange and NASDAQ, but companies are free to impose one in their corporate governance guidelines. The US exchange's guidelines do not distinguish between iNodes and other directors. The lead independent director of JP Morgan, for example, has served as a company director for over 20 years. US listed companies generally include statements on directors' length of service in the proxy statement issued for general meetings that will re-elect directors. Eli Lilly and Walmart, which are listed on the New York Stock Exchange, have said in their respective proxy statements that they believe the company benefits from having directors with both long and short tenures. NASDAQ-listed Apple, Microsoft, and Nvidia Corporation, which are all listed on NASDAQ, have commented in their proxy statements on the valuable insights and understanding long-serving directors bring to the board. Code provision B24 currently provides that if all the iNodes of a listed company are long-serving iNodes, the listed company should disclose the length of tenure of each iNode by name in the shareholders' circular or explanatory statement sent to shareholders with the notice of annual general meeting. They should also appoint a new iNode at the AGM. The exchange is now proposing to introduce a requirement for listed companies to disclose in their corporate governance reports the length of tenure and current period of appointment of all their directors by name, not just the tenure of their long-serving iNodes. The new requirement will be introduced as a mandatory disclosure requirement. One of the main focus areas of the consultation is improving board and workforce diversity. The listing rules currently require all listed companies to have a board diversity policy and to have appointed at least one female director to the board by the 31st of December 2024. The exchange is now proposing a new corporate governance provision that listed companies should have at least one female director on their nomination committee. Since current code provision B31B makes the nomination committee responsible for recommending suitable candidates for appointment or reappointment to the board, the exchange considers that the new provision will help improve the diversification of listed company boards. The exchange notes in the consultation paper that around 17% of Hong Kong listed company directors are women and that around 19% of Hong Kong listed companies still have all male boards. The Singapore and London Stock Exchange's corporate governance codes include gender among the issues to be considered in relation to the diversity of board committees. The Australian Corporate Governance Code, on the other hand, talks about ensuring the diversity of listed companies' nomination committees to avoid groupthink and cognitive bias. The exchange is proposing 2 other amendments aimed at increasing gender diversity and ensuring that listed companies have an appropriate focus on developing a diverse pipeline of candidates for the board. The exchange's first proposal is to upgrade to a mandatory disclosure requirement to the current code provision that the board should review the implementation and effectiveness of the listed company's board diversity policy at least annually. The upgrade will be affected by changes to existing mandatory disclosure requirement J. The second diversity-related proposal is a new listing rule requirement for listed companies to have and disclose a workforce diversity policy. Under the proposals, Main Board Rule 1392-1, GEM Listing Rule 171041, and Mandatory Disclosure Requirement J would be amended to require listed companies to have a workforce diversity policy as well as a board diversity policy, and to disclose their workforce diversity policy or a summary of it in their corporate governance reports. However, under proposed paragraph B of mandatory disclosure requirement J, listed companies would only be required at this stage to disclose any plans or measurable objectives for achieving gender diversity at the workforce level, whereas in relation to board-level diversity, listed companies must disclose the measurable objectives set for board gender diversity and their progress in achieving those objectives. This is because the exchange recognizes in the consultation paper that listed companies in certain industries or based in certain jurisdictions may find it difficult to set numerical targets for workplace diversity. The exchange's stated aim is to promote diversity across all levels of a company and encourage the sharing of varied perspectives. Looking at the workforce diversity provisions on other exchanges, UK listed companies are required to include in their corporate governance statement descriptions of their diversity policies for their administrative management and supervisory bodies and their remuneration, audit and nomination committees. Similarly, the Australian Corporate Governance Code requires listed companies to set measurable objectives for achieving gender diversity at the level of the board, senior executives and the general workforce on a comply or explain basis. In Singapore, it is a comply or explain provision under the Corporate Governance Code that the board and board committees should be suitably diverse in terms of gender, although there's no provision covering workforce gender diversity. The exchange is also proposing to require companies to separately disclose the gender ratio of senior management and the rest of the workforce, excluding senior management under revised paragraph C of mandatory disclosure requirement J. Currently, listed companies have to disclose the gender ratio of the entire workforce, including senior management. The exchange considers that being able to visualize the gender diversity of senior management separately is helpful in assessing a listed company's progress in achieving gender diversity. This requirement for separate disclosure of senior management's gender ratio is also seen in other jurisdictions. In the UK, the listing rules require numerical data on the gender identity or sex of the company's executive management to be set out in the listed company's annual report. In Australia, listed companies are required on a comply or explain basis to disclose the proportions of men and women on the board in senior executive positions and across the whole workforce. NASDAQ diversity disclosure requirements apply on a comply or explain basis and stipulate numerical disclosure for board members but not for senior management. The New York Stock Exchange has no diversity disclosure requirements. The exchange's final diversity-related proposal is to codify in the listing rules its current guidance on the arrangements during temporary deviations from the requirement for listed companies to have directors of different genders on the board. That guidance is currently set out in the exchange's FAQs. New Main Board Listing Rule 1392.2 and GEM Listing Rules 171042 would provide that if a listed company fails to have at least one director of a different gender, for example, if a sole female director resigns, the listed company would be required to publish an announcement immediately to explain the details and reasons for its non-compliance. It would then need to ensure its compliance by appointing a director of the other gender to the board within 3 months of failing to meet the requirement. Moving on to the proposed requirements in relation to risk management and internal controls, the exchange is proposing to revise the Corporate Governance Code's Principle D2 to emphasize the board's responsibility for monitoring a listed company's risk management and internal control systems, and for the review of the effectiveness of those systems at least annually. Currently, Code Provision D2.1 requires the board to ensure that a review of the effectiveness of the risk management and internal control systems of the listed company and its subsidiaries is conducted at least annually. As to the disclosure requirements, Code Provision D2.4 requires disclosure in the corporate governance report of a narrative statement of how the listed company complied with the risk management and internal controls code provisions, which should cover the processes used to identify risks, the main features of the risk management and internal control systems, and an acknowledgement by the board of its responsibilities for the risk management and internal control systems and reviewing their effectiveness. Mandatory disclosure requirement H also requires listed companies to confirm in their corporate governance report that they have conducted this review and whether they consider their risk management and internal control systems to be effective and adequate. However, listed companies do not have to disclose how they arrived at that conclusion or the findings of the review. The code also contains recommended best practices that listed company boards should disclose in the corporate governance report that they have received confirmation from the company's management that the listed company's risk management and internal control systems are effective, and details of any significant areas of concern. The exchange noted in the consultation paper that listing rule breaches are often the result of listed companies failing to establish effective risk management and internal control systems, or failing to properly monitor that they remain effective. It also cited the shared view of the SFC and the Accounting and Financial Reporting Council that a lack of effective risk management and internal control measures can jeopardize listed company assets, reducing the effectiveness of fraud prevention policies and impact the accuracy of financial reports, especially in the context of loans, advances, prepayments, and other similar arrangements. To ensure that a thorough review of the effectiveness of internal control systems is conducted, the exchange proposes to upgrade to a mandatory disclosure requirement the current code provision requiring listed companies to review the effectiveness of their risk management and internal control systems at least annually. The mandatory obligation would be included in Mandatory Disclosure Requirement H, which will also be amended to require more detailed disclosures in the company's corporate governance report. The disclosures required would include a board confirmation that not only acknowledges its responsibility for reviewing the risk management and internal control systems of the company and its subsidiaries, but also confirms the appropriateness and effectiveness of those systems for dealing with identified risks, safeguarding the company's assets, preventing and detecting fraud, misconduct, and loss, and ensuring the accuracy of financial reports and achieving legal and regulatory compliance. Code provision D24 will be repealed, and mandatory disclosure requirement H would require disclosure of the main features of the risk management and internal control systems and how they are identified, and of the process used to conduct those reviews and their frequency. The revised mandatory disclosure requirement will also add other disclosure requirements. These would require disclosure in the corporate governance report of any significant changes during the reporting period in the listed company's assessment of risks, including ESG risks, and the risk management and internal control systems, and the responsibilities of internal departments and external providers for reviewing the effectiveness of the listed company's risk management systems and internal control systems. Revised mandatory disclosure requirement H would also require listed companies to disclose information supporting the board's conclusion that the risk management and internal control systems are appropriate and effective, including any confirmations received from within the listed company, such as from its management, relevant board committees, and any internal departments, the company's independent auditors and/or other external providers, and the scope of the review and details of its findings. Those details would need to include any significant control failings or weaknesses that were identified in the current reporting period, or that were previously reported but remain unresolved, and any remedial steps taken or proposed to address those control failings or weaknesses. The proposed Hong Kong requirement, however, does not explicitly state whether reviews by externally engaged service providers are required or whether an internal review would suffice. As stated in the consultation paper, the Exchange intends to publish further guidance on its website on the scope of the review from time to time. The Exchange comments in the consultation paper that while its current requirement for annual reviews of the effectiveness of listed companies' risk management and internal controls is broadly in line with the requirements of other stock exchanges, the UK and Singapore have recently tightened their requirements. The Singapore Exchange's listing rules now require that in addition to commenting on the adequacy and effectiveness of the listed company's internal controls and risk management systems, the board must also disclose any weaknesses identified by the board or audit committee and the steps taken to address them. In the UK, amendments to the Corporate Governance Code's requirements relating to internal control reviews will come into effect on the 1st of January 2026. Under new Code Provision 29, the annual report will need to include the board's declaration as to the effectiveness of the material controls and describe any material controls that have not operated effectively, the actions taken or proposed to improve them, and any action taken to address previously reported issues. The annual report must also describe how the board has monitored and reviewed the effectiveness of the listed company's risk management and internal control systems. As to the requirements on the US exchanges, the New York Stock Exchange Listed Company Manual requires listed companies' internal audit function to provide the company's management and audit committee with ongoing assessments of the company's risk management and processes and internal control system. The audit committee is responsible for reviewing major issues regarding the adequacy of the listed company's internal controls. While NASDAQ proposed adopting a similar rule in 2013, it did not in fact adopt this proposal. The exchange is proposing to introduce a new mandatory disclosure obligation to require listed companies to disclose information relating to dividends in their corporate governance reports. Currently, Code Provision F11 requires listed companies to have a policy on the payment of dividends and to disclose it in their annual reports. Main Board Listing Rule 1345 and Gem Rule 1749 require the board to publicly announce any decision to declare, recommend, or pay a dividend, or any decision not to do so, although there's no requirement to give reasons for that decision. The exchange's proposed new mandatory disclosure requirement, M, would not require listed companies to have a dividend policy. However, if a listed company does have a dividend policy, it would need to disclose it or a summary of it in its corporate governance report and include in the disclosure the policy's aim and the key factors that the board will consider when deciding whether to declare, recommend, or pay a dividend. The listed company would also have to confirm in its corporate governance report that all board dividend decisions were made in accordance with the dividend policy, or provide an explanation of any decisions that deviated from the dividend policy. Listed companies that do not have a dividend policy would need to disclose that and the reasons for not having one. In addition, irrespective of whether a listed company has a dividend policy or not, it will need to disclose the reasons for any material variation in the dividend rate for any dividend that was declared during the year compared to the dividend rate paid in the previous corresponding period. The exchange is also proposing that where the board has decided not to declare a dividend, the listed company would need to disclose the reasons for the board's decision and any measures it intends to take to improve investors' returns. The exchange states in the consultation paper that it considers that the proposed disclosure requirements regarding listed companies' dividend policies and board dividend payment decisions would allow investors to make more informed decisions about investing in particular listed companies. The exchange also expects that requiring boards to explain the reasons for not paying dividends will give investors a better understanding of listed companies' capital management plans. Singapore and mainland China have also looked at shareholder return and require listed companies to disclose reasons for not declaring a dividend. Companies listed in mainland China that do not declare dividends are also required to disclose measures for enhancing investor returns. The exchange also noted in the consultation paper that the Tokyo and South Korean stock exchanges have taken steps to encourage listed companies' management to increase shareholder value. Essentially, the management team of listed companies is encouraged to give greater consideration to cost of capital and profitability, rather than just sales and profit levels, for example, by investing in research and development, which will allow listed companies to achieve sustainable growth and increase corporate value over the medium to long term. In addition to the main proposals on corporate governance that I've just described, the exchange is also proposing to make several minor amendments to the listing rules. First, the exchange is proposing to codify its existing non-binding guidance that listed companies should set a record date for determining the identity of securities holders who are eligible for certain corporate actions such as attending and voting at general meetings and receiving entitlements. Currently, Main Board Rule 1366(1) and Gem Rule 1778(1) require listed companies to announce the closure of their transfer books or register of members according to a prescribed timeline. If a record date is set without book closure, the book closure requirements apply to the record date. However, there's no listing rule requirement for companies to set a record date, although the Exchange's Guide on Distribution of Dividends and Other Entitlements provides that listed companies are expected to set a record date for entitlements, and its Guide on General Meetings states that a record date should be set for general meetings. However, these guides are provided for reference only and are not binding on listed companies. The Exchange is therefore proposing a new listing rule requirement for listed companies to set and announce a record date for determining securities holders' eligibility to attend and vote at general meetings and receive entitlements. The Exchange also proposes to amend the current announcement requirements. For a rights issue, the announcement would have to be made at least 6 business days before the record date, if there will be no book closure, or before the date of book closure. In all other cases, the announcement would have to be made 10 business days before the record date, if there will be no book closure, or before the date of the book closure. The Exchange stated in the consultation paper that the aim of this proposal is to provide clarity for listed company investors on the timing for determining their eligibility to vote at general meetings on corporate actions and their entitlement to investor returns such as dividends. The Exchange noted in the consultation paper that the optimum record date for a listed company varies according to the company. For that reason, the Exchange will not impose strict requirements on the timing of the record date. However, the Exchange's guidance will recommend a short interval between the record date and the date of the general meeting or the payment date for the entitlement. The Exchange says in the consultation paper that it considers that a shorter interval should mitigate the risk of so-called empty voting by individuals who sell their shares after the record date but before the general meeting. The Exchange is also proposing to amend the listing rules relating to the disclosure of modified auditors' opinions. Currently, the listing rules require that where the financial statements of a listed company do not reflect its true financial situation or operations, the listed company must disclose details of the discrepancies. However, the current listing rules do not prescribe the information that must be disclosed, although if in doubt, listed companies can consult the Exchange for further guidance. In its 2023 review of issuers' annual reports, the Exchange set out its recommendation that listed companies who receive a modified auditor's opinion should make certain disclosures in their annual reports. The Exchange commented in the consultation paper that its recommendations have generally been followed, and so it is now proposing to codify these recommendations. Revised paragraph 3.1 of Appendix D2 to the main board rules and a new note to GEM Rule 1847 will require that a listed company who receives a modified auditor's opinion must disclose certain minimum information in its annual report. The minimum disclosure requirements are details of the modifications and their actual or potential impact on the listed company's financial position, the management's position on major judgmental areas, and how management's view differs from that of the auditors, the audit committee's view of the modifications and whether it agrees with management, and the listed company's proposed plans to address the modifications. The Exchange proposes to amend the listing rules relating to providing monthly updates to directors. Code provision D12 currently requires management to update the board monthly regarding the listed company's performance. The note to that code provision says that the information provided to directors may include monthly management accounts and management updates. The Exchange proposes to amend that code provision to state that the board should be provided with monthly management accounts and management updates, and that directors should actively request this information if management fails to provide it. According to the consultation paper, the Exchange considers that this proposal would assist the board in assessing the listed company's financial situation and identifying any abnormalities. Finally, the Exchange proposes to amend various provisions of the listing rules to align the requirements applicable to the Nomination, Audit and Remuneration Committees. The amendments would require the Nomination Committee, like the Audit and Remuneration Committees, to be established with written terms of reference. The requirements that apply if any of the committees are not established or fails to comply with the board committee requirements will also be aligned. In each case, the company will need to publish an announcement setting out the details and reasons for the non-compliance and ensure that it complies with the relevant requirements within 3 months. As to the proposed implementation timeline for the proposals, the Exchange is planning that most of the proposals will take effect on the 1st of January 2025. Annual reports and corporate governance reports for financial years commencing after that date will be subject to the revised disclosure requirements. As I mentioned earlier, the Exchange is proposing a 3-year transition period for the proposed hard caps of 6 concurrent directorships and 9-year tenure for INEDs. These requirements will apply from the 1st of January 2028, and listed companies will have to comply with them by the conclusion of their first annual general meeting occurring after the 31st of December 2027. The consultation period has already ended, and so we're now waiting for the Exchange to publish its consultation conclusions after reviewing the responses to the consultation paper. So that brings us to the conclusion of my short presentation. Thank you again for joining me, and I hope that you enjoyed the webinar. See you again soon.